Hey everybody, good afternoon. Welcome to 12-minute trading. Today is Monday, the 7th of August in 2023. I am Doc Severson and I'm joined by Dave Lukas here of 12-minute trading. And we look forward to interacting with you guys today as we talk about what we see happening in the market. We just went through a very exciting week in the market where we were sitting here a week ago going, how long can this thing continue going higher? And we found an answer to that within the next couple of days. And so now we're in kind of this strange week where we have to wait sort of before we get into the CPI, PPI, twins later on this week, and then see what direction the market wants to go. But, I'm looking at CHOP. What are you seeing there, Dave?
All I can say is finally, right? So we've
Yeah.
been talking about how we've had exhaustion in these like longer term charts, like the weekly chart, since the beginning of July, and the energy does work. That's the one thing I will say consistently through different markets. It works. It's just at periods. It's a we're off by a couple weeks. Sometimes it's right away, but definitely just finally got that pullback now. We should go further with this, right? We should normally see this thing probably go at least 5% or so after such a big move. It doesn't have to, but today we're getting kind of a little bit of a relief bounce. Makes sense after 3 days of some pretty decent selling. We'll see how the day ends, but I wouldn't be surprised to see some selling. Maybe tomorrow or even the next day. CPI is going to be really interesting, right? This is the one that they are now thinking that all of a sudden inflation is going to tick higher, right? So we've been going trending down. Now we're going to tick higher. Now that makes sense. By the end of June, oil was up 20%, and oil is a huge input into the inflation numbers, right? So wouldn't surprise me to see higher inflation numbers this go around. The question is does how high, much higher is it, right? So they're expecting, I believe, 3.3% for the CPI. So does it hit 3.3 or 3.4? Does it come in at 3.2? Now that'll be the interesting thing. Does it come in at 3.2, which is lower than the expectations, but it's still ticking up higher, right? So a lot of the Fed speakers are out the last week, this week, and they're all kind of straddling the line. They're kind of saying, hey, more rate hikes would be needed, but they don't have to be. They're not really saying anything, if you will. And I think they're kind of waiting to see this number, the next print, and jobs was interesting on Friday. Has anybody noticed that the ADP number and the jobs number seem to be polar opposites these days? When the ADP number's high, the jobs number's low. When the ADP number's low, jobs number's high. But here's the thing: over 800,000 jobs that were created during the last, time period for the jobs number were part-time jobs. Over 500,000 jobs that were lost were full-time jobs. So, and then we had some of the other fluctuations in there. But the growing thing is the part-time jobs and stuff, and we're losing these more full-time jobs. So that's kind of what you want to see if you're trying to bring things down or trying to get people to spend less and slow an economy down, but it's early, right? So we'll have to see how this pans out.
Do you
So that's
think
kind of where things
do you
are.
think the Fed is aware of that disparity between full and part-time jobs? Because they're just
I
looking
don't
for the numbers to break
Yeah.
down, right?
I don't think they care. I think what they care about is that unemployment rate, which actually went down. So that does not help the Fed. The Fed wants to see 4% plus unemployment. That's what the Fed wants to see. So even though it's part-time jobs, right? People aren't getting fired, right? People aren't getting let go. Employers aren't slowing down necessarily the hiring. At least it's not showing up in the numbers yet. And so the Fed wants to see. I keep hearing about like 4.2% unemployment is kind of what they're looking to see. They think that's the number that things need to get to, right? The challenge for the Fed is that inflation is a very hard thing to get under control once it's let out of the box. And you saw what we had to do in the 80s for that. Anybody who's gone back and studied that period, I mean, taking rates to 18, 19% to get it because they thought they had it beat several times and it came back again and again. And we're kind of at that point, right? Because now remember, inflation, the CPI is year over year. So they're comparing to July of last year to July of this year, and inflation was going down already. So now you're comparing these lower numbers to the lower numbers, and they aren't these high 10% numbers that you're coming off of anymore. And so what you start to see is that inflation starts to bottom where it's at, maybe start to tick back up. And it's a sad thing too. I was talking about this with a family member the weekend. I had to help them understand. They're like, oh, inflation's coming down. I'm like, it's not coming down. Inflation went up 10%, and now it's continuing up 3%, 4% on top of that. Do you realize how expensive things are, right? And that's why when you go to the grocery store, you're going, why does everything cost $12, and all that stuff? Well, that's the sad thing about inflation. Once it gets up there, that's the new floor. And now we're just increasing slowly or slower on top of that floor. So prices are higher for the infinite future. It's really sad. You're not going to see 2019, 2020 prices again.
Unless we have another
sad and sick thing about it.
Yeah, unless we have another deflationary event like what we had in 2020.
Yeah, you'd have to have a big deflationary event. And what does the Fed hate? Deflation, right? And you would think, wait a second, don't we want deflation? Don't we want cars to be less expensive, our food to be less expensive, gas to be less expensive, homes to be easier to buy, right? Don't we want those things? The Fed hates it. And secretly, the Fed loves inflation. They would love to have 25% inflation because that means they're paying back all this debt, all these interest payments that we're having to pay back $1 trillion in interest now with really cheap money, right? And they love that because that's how you can continue to print money and go into debt at the levels that you are. And so that's the dirty little secret. The Fed just, and I mentioned this before, the Fed doesn't like it when you get big inflation numbers because then people notice. And that's when the pitchforks come out. So that's why their target's 2%. Nobody notices what 2% does to you over this decade. But when eggs go from 49 cents to $1.89 over a decade, you're paying a hell of a lot more, but people don't notice it because it happens slowly over time. So it's kind of insidious, honestly.
So we're just about done. We've gone through peak earnings for the quarter, actually, for second quarter reporting now. And we've got past most of the tech giants. We still have NVIDIA left to go, which will be interesting in a couple of weeks. But,
right.
We pretty much know how earnings has gone. And, the big pump from earnings has already gone and passed. So what's the market looking at right now? What does it care about right now? Besides this week's CPI and PPI, right?
Well, right now, Apple's down again today, or at least it was last I looked, which is interesting. Apple's continuing to sell off. But the CPI and PPI are going to be something the market looks to. And then the market's kind of on its own until Jackson Hole. When's Jackson Hole? It's at the end of August, right? So we've got NVIDIA and Jackson Hole just at the end of August. So you don't have that much time in between probably big events. You're going to have like a week and a half reprieve of the market just kind of not having much to go on, right? You'll get PCE, and PCE is the Fed's preferred gauge of inflation, so that'll come in. So there's always something every week, but it takes to really move markets at this point. It takes, I still say it takes things not priced in. Why did we get a sell-off last week? Because Moody's came out and downgraded the U.S., right? It's something that nobody expected, and that shocks the system, right? And that's the type of stuff that we really need to make markets move. I could actually see us being in just a choppy market, through into September and through that Fed meeting in September until we know the next, bit of future, right, that the market's going to trade off of. And that's actually, we were talking about this earlier, right? Seasonal time of year when you have weakness and, volatility and stuff. Well, I mean, the way the events are setting up is kind of just giving a good reason for the market to do that during this time.
Yeah, let me walk people through here what I'm seeing in the market. You can throw your 2 cents in as well on this. Yeah. But we had the super exhaustion signal on the S&P weekly chart, and it seemed to go on forever, and it hit a value of 30. Now I'm looking at a period of 9, so I'm not sure what a period of 14 would be on this, but typically this is where we start to see trends go to die. And then the problem that we had last week was we had a daily chart completely full of energy. And it's like the 2-year-old bouncing around in the back seat. Doesn't care where it goes as long as it goes somewhere. Could go higher, could go lower. And then the parent time frame says, no bueno, we can't go higher, or I'm too exhausted to go higher very quickly. And so what makes everybody happy is to go down. And actually, look how fast this is recharging on the weekly chart. So this is actually doing exactly what it should be.
What it's supposed to do.
What I think may be in store for us, and again, none of us know the future, but what I've seen before is situations like this where we start to rally from here. Now, keep in mind, notice how shallow this pullback has been. This is not a very deep pullback. This has been a hell of a move that we've had here. You know, from 3,800 up to 4,600, that's 800 points on the S&Ps in a relatively short period of time, you know, in about a quarter. So that's a massive move. So what we might see, and I put, you know, big asterisk around might, what we might see is we might start to see a little bit of, you know, people going for the bounce. And my sense is that I don't think this is yet ready for, you know, just new highs. I don't think we're into that yet. I think we might need to see one more plunge back down to retest support and to really shuck off all the the weak hands that are out in the market. By the time that we do this, we're going to be back up in full energy. And then we might end up seeing a full 38.2 retracement of this on this main swing from back here in March timeframe. And that would be perfectly set up. I mean, right now everybody's, you know,
the best thing would be 4,300. That would be the level. If things pull back to that would be the level that gets everybody thinking it's over and the bear's back and everything else, and that would be the perfect place to slingshot from.
Let me see what kind of fib retracement that sets up as. That would be,
I mean, 4,200 would be the.
That's
you don't want to see it below that. But.
That's a full 30. That's a full 38.2. It's a 4,300. So that would generate a ton of fear, and we'd see implied volatility shoot through the roof with something like that. And so we'd probably have implied volatility through the end of the year that we could sell the excess on. So that would, you know, I could see something like that happening. But that's going to be a tough event for people that have been buying, you know, all the way into the highs. So they're gonna get knocked off the boat, and then we're going to restart this thing. I mean, if you look back in 2020, where we bottomed out back here, we went through almost 2.5 to 3 months of shake and bake. This was almost worth 10% here. This September, October correction that we had before this thing took off. You know, and of course, you imagine, if you remember, how negative everybody was. Like, oh, we're heading back down again. And this is sort of my point with these moves these days, is like, these things will climb the wall of worry, and people are going to be posting on Twitter, and they're going to be posting on CNBC just about every day, like, oh, this is it. This is the highs. We're going to double top and we're going to roll back. Most of those people have missed this move. This is what I found for most of the time, is that people that miss the move are the very loudest bears that are out there trying to shove the market back down because they missed out on the move. They're pissed off and they want a lower entry point. They don't want to chase this, and they're mad at themselves for chasing it. So they try to take vengeance out of the market. I see it like every single time we go through this, something like that. Let's really quick look over at the NASDAQ, because you trade this quite a bit, Dave. And what levels are you looking at right now for this? We have, wow, look how fast the chart is charging up.
15,000 would be the if you could get to there on this chart, I think that would be pretty awesome on the daily chart. You know, if you could get there, I think that'd be a good level of support. It's also at a confluence of the last consolidation, so that'd be a good spot to get to. But I mean, this chart's been, you know, it's very tired, even compared to the others. So if there's a, you know, and we're kind of seeing that today, actually, you're seeing the Dow way up, and the NASDAQ's up, but it's nowhere near like the Dow or even the S&P is today. And so you just wonder, like, selling begets selling, right? So when you start to you have a chart that looks like this, you have people that made a lot of money on it, and you start to get some selling like we did last week, right? People start to say, what, why risk it? I'm gonna take some money off the table. And they start to sell out, and that exacerbates it, and it goes from there. So the first level is 15,000. There is a chance that if this thing really wanted to give up the ghost and do that full, 5 to 7%, almost 8% correction, you could hit 14,000. I think that's pretty. I think it'd be pretty tough to get there. We'd need some events that is very negative. I mean, I would think CPI would really have to be much higher than expected. Like it would need like a 3.5 plus print to really, start shaking people out and scare them like that.
Yeah, that's just about a 50% pullback on from the latest swing from March.
Yeah,
to hit 14,000.
Yeah, exactly. So that would be the, I don't see that, right? But gosh, look at the chart. Look at your monthly chart. Look at that thing. It's like straight up on there. It's crazy how that thing is gone. But I do think the back half of the year is going to be a little bit more modest for this, because I think a lot of the money's been made. I think people are going to start to take some of those profits off the table, start rolling into some of these other areas, broadening this rally out. And so tech will still continue going. I just don't know if it'll go at the same pace that it did. I think you could see it pull back some more. I think 15,000 would be a good get. I put it in a nice level there. It'd be a good place to base up and then turn around. I do think at some point markets are going to make the run for the all-time highs,
new highs,
between now and the end of the year. I do think it's too close. And it's going to have to be after Jackson Hole, maybe after the September event. Maybe we have more, volatility as we get into that, or even some more selling as we go through that period, which is, again, quote unquote seasonal. But that fourth quarter, I think, is going to be a hell of a quarter, and you're going to get the Santa Claus rally and everything else. Even if it's just that the big guys know that there's a recession around the corner and they're going to run this thing up and get as much as they can before they pull the rug, ahead of that. Even if it's just that, I think the fourth quarter is going to be a pretty solid quarter when it comes to market performance. So that's just how I see it as of right now.
Outstanding. All right. Hey, before we wrap things up today, I want to see if there's any input from our viewers that are joining us live today. So while most people are going to be watching this through a replay later on, and you're welcome to email us questions that we can bring up on the next session next week.
Actually, I'm going to pull up something for everybody.
If we have anybody today that wants to post a question to either Dave or myself, please let us know.
Yeah, we've got our year in review event coming up tomorrow evening at 7 p.m. So I'm going to get you guys the link for that so that you guys, if you are interested in joining us, can join that event. So give me 1 second. I'll pull that up. We'll post that in the chat there. So, and then if there are questions, please ask away. This is a big event. I love doing this event. It's really where we kind of look at, hey, what's going to happen for the first part of the year? Let's take a look at it. And then what did we learn from that? What changes are we going to make going forward? But this one's going to be actually pretty special because I'm doing something a little differently than I've done in the past. I'm actually going to bring in some of the things that we've been doing at a higher level, like with our mastermind group and stuff. We're always working, and I think doing a really good job of staying ahead of the market, staying ahead of where things are in the economy, as well as where things are from a macro point and the trends that are happening out there. And there's some really big things happening in the financial system right now, things with your money and all of that I think are really, really important. So I want to be sharing that on the event tomorrow with you. We're going to peel back the curtain a little bit and show you a little bit more of what we do at a higher level and give you some exposure to that. So if you have a chance to attend, please, sign up and register. And we will ensure that you get everything around this, because this can be pretty awesome. Doc, I'm going to throw that link in the chat for you and post that to everybody in the that's watching there. So, all right. And then, yes, questions.
There we go.
Or you can join tomorrow and ask your questions then.
There we go. Link has been posted.
Perfect.
Okay, so um, everybody, nothing's seen. So with that, we are going to wrap up today's session. And I think I've got some kind of a derecho or something like that bearing down on me. So I'm going to try to get everything buttoned up today before we have trees falling in our houses and stuff like that down here.
Yeah, a lot
I
of
think
storms coming through.
Yeah, a lot of storms coming through today. So everybody stay safe out there. And we hope to see you at tomorrow night's event. Is the mid-year event on YouTube. We're just going to do it on Zoom for right now. We can post it later on YouTube.
Yes, we can. We can post it on YouTube later.
Okay.
But for now, it's a Zoom link, so make sure you register with that link.
Yeah. So, all right, everybody. Thanks very much for joining us here today, and we will see you guys next week. Adios.
Bye, guys.
Bye now. All right.